Hi everyone, this is the fourth video in my short educational series, and this one is part one of price action. Okay, I'm going to talk about price rejection, supply and demand consumption, price compression, and liquidity spikes. But first, just a bit of a recap. You'll note from the examples in my last video that there are times that we can pinpoint the exact origin of the supply and demand imbalance that caused a reaction and or a breakout at an SR zone. Okay. Now, this can obviously come in great use when formulating trading strategies around SR zones and SD zones. Okay. And basing trading strategies around SR zones and SD zones is logical because these are clear areas on our price charts that represent significant institutional order flow. Okay, in order to reject price from a certain area or to move price in a volatile way, it requires institutional order flow. It's not retail order flow. It requires significant order flow in the market, which comes from the institutional space. Okay. And as I've mentioned previously, SR zones and SD zones are great places because they have a history. Okay, they have history as areas where the market has rejected price in the past. Okay, so they're historical areas where we have seen institutional order flow. Okay. Now, when I talk about finding the origin of a supply-demand imbalance, and thus where the decision was made to either break out of an SR level or retrace away from it, like I did in my previous video, I'm always referring to the most likely zones. Okay, we can rarely be 100% certain where the decision was made when we zoom into the very low time frames. Okay, nothing is ever 100% in trading. We're always working on the basis of probabilities. Okay, sometimes identifying these zones will be clear, just like the ones I showed in my last video, and straightforward, and sometimes they were not, and sometimes we weren't able to identify zones at all. Okay. Now, when it comes to price action, I've talked about, and I've kind of shown that, the first time back to a supply-demand zone or SR zone or following a breakout represents the highest chance of a further rejection of that area by price, because that is the most likely time that we're going to have a large amount of unused supply and demand left in that zone. Okay, but we can also look at price action. Okay, the price action when price is approaching the zone in question or in the zone in question, to determine with some probability as to what price is likely to do next. Okay, so this is what this video is basically all about, looking at price action. Well, the first of two parts, looking at price action as a way to determine and to increase the probabilities of our knowledge of knowing what price would do when it approaches an SR zone or an SD zone. Okay. Now, price rejection is merely the action of price moving away from an SD zone or an SR zone. I don't need to really go into detail on that. I'll show that on the charts. It's merely a rejection of price, and that's what an SR zone is. Okay, it's a rejection of price multiple times in an area. Okay, by the market. Okay. Now, supply and demand consumption. Consumption is the action of price absorbing demand or supply. Okay. The most common way to see this is on a chart in a strong trend. Okay. Now, you can see this in this example on the chart. Okay, we have an uptrend and price spikes upwards as it moves up, and these spikes, these wicks on the top of the bars, are consuming supply. Okay, consuming a supply and paving the way for price to move higher. Okay, and the same on the way down. As we move down, we have wicks on the underside of the bars as we have demand consumption, price is consuming demand and paving the way for price to move lower. Okay, you can see it again on these two examples. Downtrend, strong downtrend, wicks on bar lows as we move down represent demand consumption paving the way for price to move lower, and vice versa on the way up, wicks at the bar highs, supply consumption paving the way for price to move higher. As well as consumption in the form just described, we can also see consumption in the way price moves into an SR or SD zone, i.e. focusing on the bar movement rather than the wicks, okay? So let me look at the next example. Okay, so instead of a strong trend, we see a sort of a gradual trend into a support, where it's a support resistance area and also a previous demand zone. Okay, so notice that as price moves down, it breaks through an SR level, moves back, retests it, breaks down, moves back, retests it, breaks down, moves back, retests it. Okay, in doing this, we are consuming supply. At each retest of these breakout areas, we are consuming supply at these minor SR areas. Okay, so when this happens, when we hit the big demand area, demand comes into the market, and because we consumed the supply on the move into the demand area, it paves the way for a very high momentum move back up. Okay. Move on to another example. The same thing is happening here. We have a move into a resistance area, a strong resistance area. How do we move into it? We're moving into it in an equidistant channel. Break out, come back, retest, break out, come back, retest. Okay, we're moving in a zigzag pattern on the way into it. Okay, so that is consuming demand whilst moving into a supply area. When it's met by when we hit the supply, the way down has been paved by the demand consumption on the way up. Okay, so therefore we see and we expect to see the momentum move back down because there's a lack of demand in this area. Okay. Okay, so moving on to price compression. Compression is a squeezing of price. Traditionally, compression leads to a high momentum move. Okay, and is often accompanied by supply and demand consumption, as just mentioned, as I just talked about. Okay, move on to some examples. Okay, if we look at this example here, we have a clear SR pivot zone, and if you look at the way price is moving into this area, it is a rising wedge essentially. It's a converging wedge. That's what I call a converging wedge. But what is actually happening from a price action perspective is compression. Price moving up in a wedge-like fashion whilst dipping to consume demand. Okay, so it's exactly the same as what we were talking about before and just previously in terms of demand consumption. But we also have accompanying compression, either squeezing of price whilst moving into the resistance area or supply area, and then of course we have the momentum move back down to the source of the move into the resistance. Okay, so squeezing of price, demand consumption, wedge-like pattern, good momentum move back down. Okay, that's what we expect, and that's the price action involved in this pattern. Okay. Another example, 1 hour resistance zone, strong move down, we start compressing on the way up, dipping down to consume demand in a wedge-like, converging wedge-like pattern. Okay, move down once, move back up before dropping, eventually dropping with high momentum back down. Okay. Another example, converging wedge, moving into a support zone whilst rising, and therefore consuming demand until a point where price is squeezed so much we get the volatile breakout, the good momentum breakout. Okay, so we've talked about price rejection, we've talked about demand and supply consumption, we've talked about compression. Okay, the last thing I'm going to talk about in this video is liquidity spikes. I'm only just going to briefly go over this because I'm going to talk about it in a lot more detail in one of my future videos. Okay, liquidity spikes are short, sharp moves preceding a reversal. Okay, they can essentially be a stop loss hunt and can trap novice traders into following the direction of the move and getting trapped when the reversal comes. Okay, so in this case, this is a higher time frame. So this is, say, for example, a 1 hour SR. I think it's actually higher. I think it's a 4 hour SR. Okay, so it's a higher time frame support resistance, and this is a much lower time frame chart. Okay, so on the higher time frame, these two will appear as just a wick. So a wick, maybe a pin bar. You can't quite foresee it, but it will appear as a wick in terms of a false breakout above this SR. Okay, but on the lower time frame, you can see exactly what's happening in terms of we are compressing into this. Well, it's more consumption. We have demand consumption into this resistance zone. Okay, you can see the breakout retests of minor SR levels approaching the higher time frame resistance level. Okay, we then get a spike up, and that spike is immediately reversed back down. And following that, we then get the expected price action in terms of the movements, the strong move from the supply area relative to the move into the resistance area. Okay. So this is where novice traders will get trapped, because they'll see this big move and think, oh, we've had a breakout, we're going up, and get involved, and pure breakout traders will be getting involved. And this is why you see a term seller's trap. But what this is just it's termed a liquidity spike. Okay, it's a hunt for liquidity from stop losses, etc., and is often preceding a sharp reversal. The sharp reversal confirms that it's a liquidity spike. Okay, these aren't overly easy to spot at times, especially in real time. But if you go over your charts and just watch how price moves into a certain resistance area and look for these on the very low time frames, and you can see you'll be able to spot the big move into it and the sudden reversal, and that confirms it's a liquidity spike. Okay. Okay, well that concludes this video. It's part 1 of price action, and the next video I'm going to talk about some common continuation reversal patterns that I use in my trading. So there's a select number that I use. Okay.